Welcome back to my YouTube channel, or if you're new here, hi, I'm Antonia. I'm an accountant and a small business owner. I own Abacus Jack with my business partner Andy. Our mission is to help small business owners get more confident with their finances by using their data throughout the year to make better financial decisions. We deal with new businesses all the time, and when someone starts with an idea or a problem to solve, they need to decide how to report their income. This is because in the UK, you can trade as a sole trader or a limited company. Today, I wanted to cover off the differences between the two so that when starting out, you can make an informed decision about what's right for you. Today, I'm going to cover the legal differences between the two of them, the different tax treatments for reporting your income, the different reporting requirements that you have to comply with, and what you're likely to pay for each type of service. So sole traders and limited companies have different legal structures. If you're a sole trader, you and the business are legally the same entity. You are personally responsible for all of the company debts and liabilities. A limited company is a separate legal entity to you. Your liability is limited to the shares you own or the amount that you invest. This means that money that the company makes is owned by the company and not automatically transferred to you and not automatically yours. You can get more protection using a limited company as the directors aren't personally liable for the debts. However, be careful because if the debt is an overdrawn director's loan account, these are considered company assets and a director may be forced to personally repay the loan. So in summary, if you have a limited company, it's a separate legal structure to you as an individual, which provides some securities around personal liability. However, if you're a sole trader, it can be simpler to set up because it's the same legal entity as you. Moving on to tax treatments, one of the reasons you might consider moving to a limited company rather than a sole trader can be for increased tax efficiencies. And this is because you can split how you take the income out across multiple tax years to avoid going into the higher rate tax bracket. So sole traders are individuals, so you are taxed through income tax like an individual would be. Because you aren't an employee anymore, you suffer both income tax and national insurance costs. These are important because you want to maintain a full national insurance record so that when you get to retirement age, you're eligible for a full state pension. When you make a profit as a sole trader, the amount of tax you pay depends on the level of profit that you've made. Like when you're an employee, you can fall into a basic rate of tax at 20%, a higher rate of tax at 40%, or an additional rate tax at 45%. National insurance is payable in addition to the income tax that you have to pay on profits. And it's split into two types of national insurance, which are Class 2 and Class 4. Class 2 is also known as the flat rate, and this is £3.45 per week if your profits are over £12,570 per year. If your profits are lower than that, then you don't have to pay if they fall as low as £6,725. But if you can afford to, you really should make voluntary contributions because the Class 2 contributions are the one that make up your state pension record. And that's the one that you want to keep as a full record so that you can get your full state pension when you retire. In addition to the Class 2 national insurance, you also have to pay Class 4 national insurance. This is payable on sole trader profits, and you pay 6% on profits up to £50,270, and then after that 2%. A limited company has different taxes because it's a different legal structure. A company has to pay tax on its profits through corporation tax, which is different to income tax. Companies come to a taxable profit made up from the sales that they generate, the allowable expenses that they can deduct, and any capital allowances that they can claim, and that's called your taxable operating profit. This is then charged at a rate between 19 and 25%, depending on how much the profits are. When a company has earned some money and paid its taxes, then what's left is held in retained earnings. When you need to take money out of the company, which you will do because everyone has to live, you have to declare that personally because you're taking money from one legal entity into a personal legal entity. So there's a difference between the two. So when you move money from the bank of the company into the bank of you, it has to be reported It needs to be either a salary, a dividend, or an expense repayment. A salary is reported monthly through the company to HMRC using a payroll scheme. Any tax and deductions for national insurance on the payslip get paid monthly from the company to HMRC as a normal employee would get a payslip in a normal job. Alternatively, you can take money out of the business as dividends, but dividends can only be paid out of company profits. So if you're using a monthly strategy to take a certain amount out of the bank account and it's a mixture between pay as you earn and dividends, you need to make sure you've got enough profits each month to vote the dividends through to clear the amount that you want to take out. If you get to the end of the year and you've taken more dividends than you had profit, then effectively that becomes a director's loan balance, and that means that you'll suffer quite high tax on that director's loan balance unless you repay the money that you've overtaken. When you take a dividend, it needs to be reported through self-assessment. They're taxed at their own rate compared to income tax and corporation tax, but you declare them on your self-assessment, which might be made up of some employment income that you've got from the company, which would be reported on your P60, and then the dividends that you've taken out of the bank. Remember, if you're taking dividends out of the bank, it's best to skim the tax off when you take them into a savings account. So when you get to the self-assessment January and you need to pay the tax on them, then you've got the money saved up because you've saved it throughout the year. So instead of you paying the taxes monthly on your payslip, you're just skimming the tax monthly into a savings account, so you've got it there when you need it. Alternatively, if you invested money into the business at the start, or you pay for any business expenses through your personal account, so for example, you forgot your business card and you need to buy some office equipment and you have to pay for it personally, then the business owes that back to you. And when the business repays that back to you, it's tax-free because it was owed to you in the first place. However, as a small business, cash is key. So make sure if you're repaying expenses back to yourself that the business has got enough cash to pay its future liabilities, like employees or the HMRC, because you don't want to get behind on those. An advantage with a limited company is if you have a bumper year, so say you've made a big profit and it's been really successful, and that's great. But if you take all of that income out at that specific time, it's going to push you into the additional rate or the higher rate of tax. Then you can avoid doing that if you don't need the cash right now. What you can do then is you can leave the money in retained earnings in the company and then take a bit by bit across 2 or 3 years to keep you in the basic rate of tax, which is then saving you potentially 20% on tax. Alternatively, you could take all the money and then pay some of it into a personal pension, and that will give you a similar relief because it'll increase your basic rate band back up. But also with a limited company, you can put personal pension contributions as a cost if you're a director, which means that you save the corporation tax and you get the 20% top up in your pension, which is a pretty good deal too. So between the two of the types of legal structure, the sole traders report their income differently to the company. A sole trader is an individual, so they are taxed through self-assessment. So self-assessment, the tax year runs from the 6th of April one year to the 5th of April the next year, and then you have to report your income by the following January. You do this on a self-assessment return, and effectively you calculate your self-assessment profits, and then you work out the tax and the national insurance amounts that are payable on the profits that you've made. Because it's self-assessment, if you've made a big profit and you have a big tax bill, then you'll also have payments on account to deal with. And these are prepayments towards the next year, but it can mean that your first January payment is actually higher than you expected because it's actually a payment and a half. If you have a company, there are a number of statutory documents and returns that you have to file each year. Firstly, you have a set of company accounts, and you have 2 types of the company accounts. You have one set of accounts that goes to Companies House, then you have another set of accounts that goes to HMRC. Then you have what's called a company tax return, which is known as a CT 600, and this takes the income that's been declared in the accounts and declares what corporation tax you're going to pay and which rate you're paying it at. Then also every year you have to file a confirmation statement to Companies House declaring if there's been any changes to addresses, shareholders, directors, because Companies House needs to be kept up to date as well. And then if you're a director of a limited company and you've taken any dividends out of the company, then you need to do a self-assessment return as well. From your self-assessment return might be made up of dividends that you've received from the company, and also potentially if you have a payroll scheme set up on the company, then you might get a P60 from the company which summarizes all of your income for the year, and that goes on your self-assessment as well. And that tax year runs April to April like the sole trader. However, the company dates can be completely different. So if you want a year end of November or December or January or June, it's up to you when you set up the company. That means that you might have dividends voted in 2 different financial years for one personal tax year. And that's sometimes why it's good to use an accountant, because we get that. So in the beginning, if you're a sole trader, it can be cheaper to stay as a sole trader, because if your earnings and profits aren't really going above the basic rate threshold, then you don't have to worry about driving out as many tax savings. A self-assessment return is just one document, so that can be much cheaper than a limited company who has to have a set of accounts, a company tax return, a director self-assessment, and a confirmation statement. In terms of VAT registration, you can be VAT registered for both a sole trader and a limited company, but you remember you only have to get VAT registered if your turnover is going to be over £90,000. You can do it before then if you want to voluntary register, but don't let anybody force you in saying you have to be VAT registered, because you don't unless you cross that turnover threshold. And also for both, if you're a sole trader or if you're a limited company, get a good system to help you with the admin. You can save so much time, stay so much better organized, and save money on your returns at the end of the year if everything's in a good position, and you can make better decisions if you have access to see what's going on throughout the year rather than just waiting for your tax bill at the end. So whether you're thinking about starting out as a sole trader or a limited company, remember you can always switch later as your business grows. The key is to choose what works best for you at the moment, and getting the right advice can make all the difference. If this video has got you thinking and you'd like to chat with me about your business idea, I've added links below, so feel free to connect with us. Don't forget to subscribe for more small business tips and advice. And if you found this helpful, hit the like button. It really helps the channel. I also share daily content over on Instagram, so be sure to follow us there too. Have you got any questions? If you do, drop them in the comments and I'll get back to you. Thanks for watching, and I'll see you next time.